Ready when you're.
Okay. We're on, Robin. Welcome everybody to the Investment Committee meeting of Wednesday, the 12th of February, 2025. Welcome to Peter and Jonathan from Eriksens, and to elected members, and to Kip. So we'll start with the Karakia Timatanga. You get that?
Mai te pai maunga ora pērapai, mai te awa taonga ora
Aroki
Nei te hapuri,
Awhiai
tatai whana,
Haere mai te tau.
Haunge, huie, tarahi.
So do we have any apologies? I think we have a full house. Any conflicts of interest anybody needs to complete? Seems not. Public forum doesn't seem to be happening. So we'll move on to the confirmation of the minutes of the Investment Committee meeting held on the 13th of November 2024. People have seen them, prepared to use with our record. Does anybody have any comments? Seconded. Steve? You mean? All in favour?
Aye.
Okay, so we would move on then to the reports. Investment report to the 31st of December 2024.
May I jump in, Chair?
Yes, you can.
The committee will notice that we've split the agenda into two segments, one being a public segment and the second being a public excluded segment. I am really conscious that we are asking Eriksens to provide investment advice and that investment advice is proprietary to Eriksens. So I am conscious that having that in a public forum and producing papers and making them public kind of undermines that proprietary nature of the advice we're receiving. So I have split the report into two. So there is a public section and a public excluded section. And I have anticipated the conversation to be slightly more tailored towards Carterton District Council at the public excluded session, because that's the advice we are asking. I hope that is for the committee.
Cool.
And I hope I've done it the right way for Eriksens and not put the wrong one in the wrong agenda pack.
You've done well.
Thank you.
Okay. Do you gentlemen want to speak to where we are, and then we'll disagree with you?
Excellent. That sounds like the right way around. So I'll kick off. And I'll probably just have a few comments. I'll take the whole report as read, of course, and start you off on page 18 of the pack, which shows a table of returns for all the fund managers and the fund overall. I mean, it's been a good quarter and a really good year for investment markets. New Zealand equities played catch up in that quarter, returning 5.5% and ending the year in double-digit territory. We saw Australia struggle a bit over the quarter, but they were in double-digit over the year as well. And of course, if you've read any press lately, the US market and you know, as it represents about 70% of global markets, meant that the overall global equity returns were over 20% for the year. In fact, over 30% if you put them into New Zealand dollar terms, which is another thing to think about, actually. I mean, you look over the quarter, and a lot of literature coming through says, you know, global shares did about 13%. Not exactly true, though. They were only a couple of percent for the quarter, but because the Kiwi fell so far against the currencies, particularly the US dollar, for New Zealand investors, unhedged that is, ended up with a double-digit return over that time period. Most of those returns from offshore equities was a result of the what's called the Magnificent Seven, which is companies like Apple and Nvidia and so on. Certainly make some comments about that as we go through. Bonds did okay over the year, around about 5% from govies, around about 7% from the A-grade corporates, so quite good over the year as well. Looking at the table of returns, so over the quarter, a 2% return overall. So the highest performer over the quarter was Castle Rock, which is their income distribution. So because they didn't change their share price over the quarter, that's the income coming through, which gets paid completely out of the income coming through from the underlying companies. But you saw some good quarterly returns coming through, particularly from Harbour as well, and quite pleasing returns over the year, around 10% for Harbour and 9% for Milford. Even Castle Point sitting at 7%. One of the managers in the Castle Point suite, the highest part of their portfolio, is a global equity manager called Te Ahu Marangi, who look at companies like Nvidia and have actually said in their literature that they're ridiculously overvalued. And when you're paying price to earning multiples of over 100 at one point last year, you got to actually think, that's actually right. So a lot of those big returns that you saw didn't get reflected in the portfolio because of the more conservative nature of the fund managers involved. And another manager in that suite for Castle Point is Schroders through their Global Value Fund, and again not exposed to the likes of Nvidia because of those reasons of just being way too overvalued. But there's still really good, if you like, safer returns to be generated through portfolio that are positioned towards more, realistically priced securities within that portfolio. For the likes of Milford, we saw them have some really good gains, and then they've started to add more cash into the portfolio as time's gone on, as they get a little bit more conservative in their view, looking forward about, in particular, equities. Any questions on that particular front in terms of the managers or the returns?
I've got a few dumb questions, but I might hold them to the end, actually. Just
that's fine. That's fine. So the other thing I wanted to just have a quick look at was on page 21. So this is the asset allocation. These ranges and targets are set out in the SIPO. So first of all, just acknowledging that everything's within range, comfortably within range. And also there's a table there that shows growth, income and cash assets. And you'll see there that the growth assets are sitting around 48% of the overall portfolio. And as you'll know in the SIPO, the risk tolerance that has been selected is that of a moderate investor. And if you go to any survey, the 48% fits very comfortably in the moderate category in terms of a risk profile. And where those come from is that each portfolio or each fund that you're investing into has an allocation to growth and income. So growth is shares and property, and income is bonds and cash. And you can see the allocations going through the funds as we go there. So Castle Point, with a higher allocation to growth than either Harbour or Milford, and of course Castle Rock being in private equity is 100% growth. So you weight that by how much you've got in each of them, and that comes out with the overall saying that we're nicely in the category that's been selected from a risk perspective. That's all I was going to say, but I'll take some questions before handing over to Jonathan to talk about the markets, where they've been and also where they're going.
Maybe? Yeah, sure. So here with me, they're probably really simple answers here, but on page 15, you have normalised. So to me, that means they'd be going up and flattening off. Would that be right?
Page 15, sorry.
Yes, you are. Interest rates are going up and flattening off.
No,
But
that's right.
if I'm jumping ahead a little bit, but the point is that with President Trump, his new Secretary of Finance is saying that he wants to get long-term US Treasury yields down. But the policies that President Trump is issuing by executive orders have the opposite effect. And so it's actually going to be quite messy. But what has happened is that in the last 3 years, interest rates, which were practically rock bottom post-COVID and in 2022, have got much more realistic and what we'd say normal. And in particular, the longer duration bonds have a higher yield than the cash bonds in most countries now. In other words, we don't have an inverse yield curve, which some people think is a predictor of recessions. So yes, no, you're absolutely right. Interest rates have normalized, and we think that at the short end, New Zealand is actually in very good shape. We're expecting a 50 bip cut next week, and or this month, I should say. And we are hoping that we'll get down to around about 3.25% by the end of the calendar year. That's the cash rate, which was at 5.5%, of course. So that's a big improvement, and mortgage interest rates have dropped as well. Now, at the long end, and I'm talking about New Zealand government stock here, the long end is at the 30-year bond is still over 5%. And that could actually sneak up towards 5.5%. But that's still a very normal interest rate for any of us with a bit of grey hair. It's actually very benign in terms of an interest rate environment for people who need to borrow money.
Thank you. Still on that page, that second to last paragraph, you've made a comment but left us hanging, not to mention gold and crypto. What is meant by that comment?
So gold and crypto are both, if you like, fiat currencies. In other words, they're used as a medium of exchange. They don't have any intrinsic value of their own, although in gold's case, that it's always had this amazing intrinsic value. It didn't serve the Jews very well during the Second World War because the Nazis took all their teeth and got all the gold fillings out. But in that sense, and gold is still a very good form of jewelry and has a few practical functions, but not many. Crypto is just speculation in our view. But we have actually got a few high net worth type clients. We wouldn't ever say to an institution that you should have some gold, but the gold price has gone up from 2,700 at the end of last year to 2,900 today in US dollars. And because of the weak Kiwi dollar, you know, you're looking at $5,000 to $6,000 an ounce at the moment, which is not to be sneezed at. So that was a slightly tongue-in-cheek comment, because we often get asked, not by sensible counsels like yours, but by some investors, shouldn't we invest in crypto? To which we strongly say no. And as I say, we've got the odd client that has a bit of gold, but it's not really the sort of stuff that we recommend. If they want to do it, we say, yes, no problem doing it now, or no, you should be selling instead. But now's the time to hold on in case the US dollar depreciates a lot, right? Now, what's happening at the moment in terms of gold is that a lot of central banks, in particular, the Chinese, the Russian, and the Indian central banks, they're all BRIC countries, of course, they're buying a lot of gold because they're concerned that the US dollar is going to drop as well, and they want to be able to keep trading and not have to use their US dollar reserves. But funnily enough, China has actually started increasing its US dollar reserves a little bit, although our latest figures don't take into account the fact that they now have a 10% tariff on their goods put on by President Trump.
Thank you. And the last paragraph on that page, you talk about a stock market correction. So obviously, you just mentioned gold, a possible correction, or just the risk associated with holding it,
Yes.
and crypto. But what's your view of the size and timing of that possible correction? And you're just talking about stock. I mean, the longer we go, the more likely it's going to happen, of course. But
Yes. Yeah.
is that what you're saying? It's reasonably
No, it's worse than that. So this is perhaps something for the private public excluded session, but in my personal opinion, this is the most difficult time for investors to invest in markets ever. And I don't just mean in our lifetimes or the last 100 years or the last 200 years. I mean ever, right? Because at the moment, President Trump is rewriting the rule book on how a so-called large, economically developed, liberal democracy works. As Peter said earlier, the US stock market represents 70% of the global listed stock markets, right? Again, the timing is really tricky. I picked the crash that happened in 2022 way back in 2015. I was only one economic cycle out. Peter will tell you that you can't time markets. But we think that definitely within the next 3 years, and I personally think it's going to happen this year because of the pace with which two things are changing. One, the US economy is basically changed its nature completely. It's like a leopard with different spots. But also because of AI and the potential impacts that has to change the way society works and how solutions are found to problems. Both of those mean that we can't rely on everything to stay much the same, which is what the markets do. They have good years and bad years, but people still expect you to be able to get some money out of a bank, or if you're trying to sell a share, you should be able to find somebody to buy it on the other side. You may be interested to know that we had our regular Eriksens Global Investment Committee meeting a few minutes before this session, not in preparation for this, it's what we do all the time. And Peter actually went back into his memory banks when there was a run on liquidity, and a fund that had 50% in cash used it all up in a week. So getting back to your question, we think a 20% correction is highly likely in the next 12 months. And if things turn to custard, it could easily go down to 40%. Now, I should remind you that happened in both 2020 because of COVID and in 2022 because of the bond sell-off, which is why our comment about bond interest rates normalizing is very important. It means that bonds are much safer than listed equities at this point. So in that sense, we're not talking about a 20% sell-off in bonds at all. We're saying that your moderate portfolio, I mean, you are a pretty shrewd bunch, if you don't mind me saying so. And I'm trying to pay you a compliment. I'm not being rude. But picking a relatively low risk, moderate risk profile at the beginning when you started investing is paying off in spades right now. We're doing a strategy review for a large client who normally have a 60-40 split, 60% growth, 40% defensive. We're saying to them that they should dial that back to 50-50. You've had your 50-50 split from the beginning of these managed funds. So well done.
Thank you.
We'll take your congratulations, but I'm not sure it all belongs to us, really.
Page 18 on that table of returns. Performance. Can I just ask, can you just confirm the percentage returns on the 1 month, 1 quarter, they are just over the period of that 1 month or the quarter, they're not annualised?
That's correct.
And secondly, the 2-year and inception rates, are they annualised?
They are, and that's a really good point. We haven't put per annum in the top. I'll make a note of that and have that for the next report.
Thank you. And in the commentary underneath, you talk about defensive assets. Is that just conservative, or is it actually trying to go against some trend?
Yeah, no. So your more defensive assets, I mean, it's your more income focused assets. So that's either cash, that's bonds, but it can also be defensive equities as well. So more yield focused equities is included in that. As in the case, as I said before, of a global equity manager within Castle Point, Te Ahu Marangi, that is looking at those more defensive stocks compared to the what's called the growth stocks, which is the ones that are shooting the lights out at the moment.
Thank you. And then page 21. In those tables, the column values, so those, where do those value figures come from, and do they differ from the fair value in the financial statements, or just it's a completely different thing?
Yeah, so these ones are market values for those portfolios. So for Castle Point Harbour and Milford, it's simply how many units you've got multiplied by the unit price. And for Castle Rock, it's how many shares you own multiplied by the share price.
Okay, thank you. So, thank you. Answered the other questions I had. Thank you.
Right.
Anybody else? John, Peter, can you give us an idea of roughly what our split is between New Zealand and offshore assets?
New Zealand and offshore. So, yeah, give me a moment on that one. So, for Castle Point, you've got about 69% is offshore. For what else can we got here? Here's Milford. That's around about 30, 50. It's around about 60% offshore. That includes Australia, though. I mean, if you don't want to include Aussie, then it's probably more around the 40% mark. For Castle Point 5 Ocean. Oh no, I just did Castle Point, didn't I? It was the other one, Harbour. Not sure I've got Harbour here. Oh yes, I have. So Harbour helpfully does not split its domestic and offshore, but Harbour is more bond focused. So it's pretty much all domestic, I would think.
Oh no, there's about 30% of global in there as well, Peter, in the equities.
Oh, global bonds.
Global bonds and global equities, but it's at least 70% domestic, yeah. But that includes Australia to some extent too.
Right. Yeah. Excluding Aussie, it's not high at all. And then of course Castle Rock is 100% domestic.
Cool. And just a comment from me, I was encouraged to hear you say that the fund managers we don't have a lot of NVIDIA stocks, because I think when people found out about the new Chinese AI, it was $1 trillion US came off the value of NVIDIA overnight. I mean,
overnight, that's right.
That's a big number.
I mean, when you think about valuations of these companies, it's a bit like a rubber band. The bigger it gets, the more you're stretching that rubber band, and something happens, and then bang, it comes back really quickly. So, and this is one of the things that you're going to see is quite a disparity between fund managers in the market, particularly if you're having a look at things like KiwiSaver surveys, because a lot of the fund managers invest passively. And passive, of course, just buys the market. So they're going to buy all of these Magnificent Seven, and they will be having their marketing machines going out saying how wonderful their returns were over last year. But Jonathan and I have been through many investment cycles, haven't we, Jonathan? And, time and time again, we see that those gains aren't ones that you can necessarily bank. Similar to currency gains, actually, when you think about it. And, if I think about the one that Jonathan was talking about, which was back in the early 2000s, the returns were just astronomical. And for many years, a lot of fund managers were saying they're overvalued, and the year after it would still go up, and the year after that. But when it came back with a vengeance. And, looking over the whole, say, 5-year period to 2003, the people that didn't hold those overpriced in those days, internet stocks, were the winners, actually, over that whole time period. So taking the long-term view is definitely the way to go, and that's what we've set up here with this portfolio.
Anybody have anything? Come to public exclude, but not a while. Machine's gone.
Jonathan, were you going to add some more comments on the global economy? Or you covered that?
Well, I've only half covered it. I'm very happy to expand a little bit because, as I said, it's a really complex time. And just to put that little hiccup that the NVIDIA share price had when DeepSeek was talked about, the Chinese AI lookalike, if you like, that was a 17% fall in NVIDIA shares in that one day, right? And one of the things I said is that you could potentially get about a 20% correction. So just a little bit more than that, but across a much wider part of the market. So as well as the volatility of the stock market and the impact that these tariffs, if and when they come on, are going to have, and the potential for other countries to put tariffs on as well, you're looking at a reduction in growth around the world, and then also an increase in inflation. Now, inflation is actually one of the key things, because if you're a poorer person, a lot of these voted for President Trump in America. If inflation doesn't come down, then the cost of food is high, and they struggle because obviously a bigger proportion of their income goes to provide bread on the table. So in that sense, it is going to be fascinating to see whether the so-called economic efficiencies that the US administration is trying to get can actually be achieved without increasing inflation and reducing growth, which are the two things which the Federal Reserve has worked very hard to manage over the last 5 years or more, and has done a very good job on. So, and that's the US. The geopolitical stuff in the Middle East and in the Ukraine is also getting disrupted. So you may like to know that one of President Trump's planes has landed at one of the airports in Moscow in the last 24 hours because one of his advisors is going to talk to the Russian government, presumably about stopping the war in Ukraine. But that's unlikely to succeed. And obviously the hostage release situation has got messier rather than simpler as a result of the US interventions or statements about interventions. So in that sense, too, we've got climate change and supply chain disruptions. So I don't want to depress anyone, because New Zealand is the best place on the planet pretty much to survive a nuclear war if there is one. Not that we'd have much of a chance, but in the meantime, we've got a very good small economy, which is gradually coming out of recession, and that recession was partly caused by the Reserve Bank pushing up cash rates very quickly. We think at the right time, and then bringing them down almost equally quickly. But in the meantime, the government sacked a whole lot of public servants in Wellington and put the Wellington economy into recession. And being New Zealand's third biggest city, that had a country effect, but also it's spread out to the regions. And so in that sense, we had a real double whammy of two causes of a recession. But the tourists are coming back and house prices have also stabilised. I wouldn't say normalise in that case, because I think they're probably still too high for the average first home buyer. But we are building a lot more houses. So hopefully supply and demand can equate. So in that sense, our overall view is that your philosophy and positioning for risk of protecting capital first and getting reasonably good but steady returns second is paying off. And quite frankly, I think you should be very well satisfied, and hopefully as an investment committee be able to sleep at nights with your current portfolio.
Thank you. Anything further for this part of the discussion? So we have one recommendation that the committee receives the report. And do I have a vote for that? And so Newman, seconder. Worship the Mayor. All in favour?
Aye.
Aye. Recommendation is carried. How did everybody do? We don't have a meeting, I can't. Now, I'd like to move that the committee move into public exclude for the next wee while. Do we have a second for that? Everybody in favour? Aye. Anybody against? Carried.